this session is going to be very focused on get, set, go. How do you start, understanding the stock market? So we're going to be staying focused on that. And we would love for you to have questions on that topic. And, the chat is open. I will now bring in Ravi, who would set some context and then hand it over to Shailesh. But very excited and welcome everyone. And I hope you really enjoy the session. Over to you, Ravi.
Oh, thanks, Shruti, and thanks everyone for joining. Since we are talking about kickstarting the stock market journey, I think let's understand the profile of the participants. If you can go through with the 2 standard questions that we ask, Shruti.
Yeah, just trying to get that up. Here's the first one. Can you see it, Ravi?
Absolutely, yeah. Okay.
That's what it's looking like today, Ravi, for us.
I think the demography is fairly evenly spread, tilted towards elders, which is good in terms of context, because a lot of us begin at various places in life. In fact, I started my marathon running when I was 48, and so no age is the age. So this is good. Can we go to the next question on experience?
Yes.
Absolutely, at the old people have to start somewhere.
We have a lot of 25 to 40-year-olds, so please keep them in mind as well.
That's where we have Shailesh. Yeah, excellent. Here again, I think majority of the folks are less than 3 years, so I think introduction makes sense. I think this is good. Shruti, we'll move on.
Yeah. Okay.
I'm going to take about 5 to 10 minutes preparing people on what does it take to invest in stock market. Okay. And I have seen generations of investments in stock market from the days of paper trading. So I want to go through and set some framework for new starters to start and some of the elders to correct their lives. Okay. While I consider myself a new person to this investment industry, I started investing in 1980. And so you keep learning and it's all fresh at all points of time. Shailesh, can you move ahead? We have always been saying that investment is an active process, and you can never leave it to somebody else, including if you have a wealth advisor who does it for you.
Ravi, can you be a little louder, please? Just a little louder. Yeah.
So I've been saying that investment is an active process, and so it requires participation from each of us. Even if you're allocating monies and giving it to a wealth advisor to manage it, you need to be active about it. It's extremely important. Shruti, am I audible?
Yes. Please, you're good. Go ahead.
So it's very important for us to participate and be active. Don't leave it to Shailesh and gang to manage our money. No, Shailesh and gang will help us, but we need to manage our money. Is very important, which is why we keep insisting that it is you plus AI is going to give success and not just leaving it to somebody else. Let's move on to the next slide. This is a favorite perspective elders will give, and more importantly, Akshay is particularly enthused by the fact that it is not just you, it is not just AI, it's also about time. Staying time, having a perspective which is longer term is essential if you're going to come into investing in stock market. Otherwise, you have to put your money under your pillow and wait, because time is a perspective and time delivers so much more that AI cannot deliver, that we have and our smartness can't deliver. So time is important, and waiting it out is equally important, both in good times and bad times. And I will talk about this particularly, though that is not the focus of today's conversation, because when I say time is important, it is also important to be calm in this whole investment process. When the markets go up, don't pump so much more money thinking that everything is going to be honky-dory. Or when the market crashes, don't just exit and panic, because it's very important for you to know what sort of a time perspective you have and give the time. And if you can't give the time, don't invest in the stock market. Let's move to the next slide. Yeah, it's the same. So you and time and AI, all three will compound and deliver value. So InvestorAi will help you if you participate. If you subscribe to InvestorAi, and if you are not going to have your own views on what to do and what not to do, you're not going to make money. So subscribe to InvestorAi is okay, but then you should spend time, and you should also recognize that investment is a long-term process. Can you move ahead? So I wanted to give a different perspective to all of us. So we spoke about you and AI. That's a core thing that we talk about, and time. But then doing it right is also important. We might say Tesla is a great stock. AI might say Tesla is a great stock. All of us might agree Tesla is a great stock. But even then, you need to be able to time the market. And so it's very, very important for us to have tools that will help us. And that's what all our sessions on InvestorAi has always been about, is helping you to do the things right at the right time. The next thing is about process and practice. And when you get into this market, recognize that you need to be learning at least a few things that have to do with the market. And that's what of today. And Sailesh is going to talk to us about it. When I got in and started trading, I mean, I was always trading and investing at market price, and suddenly Sailesh told me, hey, wait when you buy, and similarly wait when you sell if you can. So it's all about timing, it's all about costs, it's all about, so we are going to learn the mechanics today. Third part of it is also important, which we all need to be talking about and working on, is patience. And patience is easier said when things are going well. Patience is equally important when things are not going well. And that is where I say it's about your personality. If you are a person who's going to panic every often, or if you're going to be overjoyed every often, stock market is not the place. It's important for you to be having that equanimity when you take a decision, and allow the machine to recommend you and have the right process, and not just jump around. If you're going to jump around, you're going to lose. And traditionally what happens is people invest when market is high because they think it'll always go up, and people exit when it is low and they think that world is going to come crashing. Both are true. Markets have been eternally going up for the last n number of months, and similarly when things crash, it may go on for a few more months. But it's very important for us to figure out that our own time perspective is important. So personality is important, and we need to check ourselves as to what sort of a personality we have before we go into it. And that's where patience and the time perspective comes. Yeah, so with this, I'm leaving it to Sailesh to talk to us about the second one, which is the process and practice. What should we do and what shouldn't we do? When you set up an account, when you do the trades, when you incur costs, when you make money, when you look at taxes, leaving it to Sailesh to talk to all of us today. And over to you, Sailesh.
Thank you, Ravi, for setting up the framework. I think, as you said, it's very important to have the right patience and persona, and how you, the psychological aspect of investing and trading. I'll jump straight into it. So I'm planning to cover how to open accounts, what sort of companies are there, how do you look at from your first step, how do you look at stocks and companies? I speak a little bit about taxation and then a little bit about how to handle trading. So let me jump straight in. So for you to to make either a trading or an investment, you need two accounts. One is something called a demat account. It's like a bank account, but for shares. Okay, so it just holds the shares in your name. So you buy something, it will come and sit in your bank account, and that's basically a demat account. For you to enter the trades, you need a trading account. So in the trading account, it will temporarily buy and sell securities, and whatever remains will actually be pushed to your demat account. So that is like your asset. So you buying some company shares will be an asset for you. Okay. Now, just FYI, there is also something called a POA you will need to authorize. Basically, what happens nowadays, because of the new rules, every time you sell something from your demat account, you need to authorize it as per giving some OTP. Okay. Basically, authorizing your demat to give the shares. Now, that's a very cumbersome process. So there is a power of attorney which your broker will give you. If you sign it, basically the sale will be immediate. So that's something you would want to keep in your mind. Obviously, the biggest thing about getting into investment, not the biggest thing, but one of the biggest things is basically the charges and the fees that you need to pay. Over time, when you do a lot of trade or not even a lot of investments, it could significantly impact the net returns that you make. So that's why it's very important to keep the costs and their service intact. So let me start with brokerage. Now, brokerage is normally charged as a per trade brokerage. So it will either be like some amount or some percentage of your trade every day. For example, 0.05% or 20 rupees per trade. So this is how brokerages are there. Now, these charges are normally put on both buying and selling, and across brokerages, there are different prices, which is, so before you enter into, before you decide of having a brokerage account with someone, you need to be aware of all these costs, especially brokerage. Now, many brokerages nowadays are offering zero brokerage. Now, what does that mean? They'll actually tell you that it's zero brokerage and zero cost to trade, but it's not zero cost to trade, it's just zero brokerage. So when you buy and hold it for delivery, no charge on brokerage. However, there will always be other charges which will be charged by all of these brokers. So for example, something called AMC charges. This is basically maintaining your account. They charge anywhere from 300 to 400 rupees per year. Everyone charges it. And then there is DP charges. Every time you sell something from your demat account, it charges 15 to 30 rupees per security. Regardless, even if you're selling one share or 10,000 shares, you will be paying 15 rupees per security. And there is also something called STT, which is securities transaction charges. Then there is stamp duty, exchange levy. So all these things, small charges will either come up, and the minimum you will have to pay is 0.1%. And of course, with brokerage and GST, it would just go up all the way. Some people have seen paying almost 1% of your trade value as brokerage, which is very big. And that's what used to be there about 4 years ago. And nowadays, it's coming down. So be very careful about looking at brokerage. Now, why I'm talking about just brokerage is, but there is also brokers who give you other things as well. So for who's a good broker? So a good broker who is, first thing when you're looking for a broker, the first thing you need to look at is someone who has good tech, whose systems are very good. We have heard a lot of people where they want to sell and their brokerage system is hung. They cannot place orders. So all these things, basically, sometimes, especially if you're doing options trading at all, would be massively headache. So that's one. Second thing, obviously, is brokerage. I've already spoken about. And then finally, there's something called margin offering. Some brokers will give you research reports. Some will give you tips. And depending on what sort of user you are, you can pick those brokerages. And obviously, as the service offering goes up, the brokerage also tends to go up. Okay. Now, let me talk about companies and try to break them down through different methods and actually try to tell what is happening. So first one, I'll talk about size. Now, when someone says size, we all mostly refer to market cap. What is market cap? It is basically price of the share into total number of shares that is outstanding in the market. When you multiply it, you get market cap, and that is what you call, hey, this company is worth this. Reliance is worth 13 lakh crore. That is the market cap of Reliance. So basically, if I look at every company would have market cap, and if I divide them into three sections, right? Companies about 25,000 crore are called large cap. Okay, and companies below 5,000 crores of market cap is called small cap, and anything in between is mid cap. Now there's only about 100, actually 70 companies which are large cap, and about 150 companies which are mid cap, and rest 1,500 companies are small cap. Okay, so the universe is actually, in terms of number of companies, it's way more small cap. However, in terms of value, when you put up the market value together, large cap is a bigger chunk. Okay. Now, why is this important? How does it matter if a company is large cap, mid cap, or small cap, right? I want to tell you that that these sections of the market behave differently during different market periods. For example, I'll take the last 1 year. In the last 1 year, the Nifty, which is the main index, which is comprised only of large cap, is up 45%. Okay, last August to this August. The small cap index is up 78%, despite losing 13% in just the last 2-3 weeks. What does this mean? When markets are going up, there is upside, everything is going well. Small caps will outperform mid caps, and mid caps will outperform large caps, because smaller guys will tend to grow. They have a lot more to grow, and they'll just do well. However, when things flip, for example, the COVID period, right? There was just 1 month of period where everything collapsed. Small cap index was down 43%, whereas the Nifty was just down 33%. So basically, when things go south, things will collapse more in small cap. So as Ravi said, you need to have a view on the market, and based on that, you need to position yourself, and the right mix of large cap, mid cap, and small cap should be in your portfolio. So if you think, hey, markets may not do too well, it's stopping here, it's like at the top, it may not go up too much, then you will have a higher allocation to large caps. Or if you think, hey, there's so much upside, there's so many companies that are cheap and all, they will always be in small cap. So that's one view that you would need to have. So next, let me break down the companies by what businesses they do. The two broad classifications are something called defensives, which is the first row you can see, and the second one is cyclicals. Now, if you look really closely at how these are being broken down, you would see that defensives tend to be less volatile over time. So they wouldn't move around too much. They wouldn't suddenly be up 40% and then suddenly crash 40%. It would be very low. And cyclicals will be much more volatile. And that's why the name itself, cyclicals. They indicate that these companies' business cycles will tend to move around a lot. Just to give an example and why this is, for example, let me talk about consumer staples, right? HUL, your soaps, your food, your rice manufacturers. The thing is, look at them as a business. Whether there is COVID or no COVID, you will always go and buy soap. You will always go and buy toothpaste. You will always go and buy rice. So what happens? These companies will have a very stable earnings growth, very stable sales growth, 5%, 7%. Slowly they will grow. Okay, it will always be there. Healthcare, people will always fall sick. They will always buy paracetamol. People will always use phones. They will always need power grid or NTPC to generate power. But now let's talk about the flip side in cyclicals. Let's speak about materials, right? The largest one right now, Tata Steel. It's up 300%. It went from 400 to 1,400 in just a matter of months. Why? The iron ore prices are going up. And suddenly they made 6,500 crores profit in just 1 quarter. Now, Tata Steel actually made losses 2 years ago. And now they made the 3rd or the 4th highest profits out of all the companies. However, TCS has been consistently making profits over time. So what happens? Business cycles also make the stocks move. So over long run, this is how it will move. And that's why people will always value defensives more than cyclicals. They will always be more expensive. Now, just because something is expensive doesn't mean it will not go up, and just because something is cheap doesn't mean it will go up. That's why, for example, Tata Steel, as I said, almost made as much profits as TCS last quarter. However, TCS is 8 times more valuable than Tata Steel in terms of market cap, and yesterday Tata Steel was down 10% because people thought things would come down. So you can't even compare Tata Steel with TCS. And that is the point I'm trying to make. Just because some company makes more profit than the others doesn't mean it's more valuable. It's all about cyclicality. It's all about how consistently the company is growing. And that's an important view. Now, the biggest reason why you need to know about this is because when you create portfolios, you need to ensure that you're diversified. Now, what does diversified mean is not one single risk can cause you too big a loss. Okay. For example, you put all your money in IT companies. Okay. 100% of your portfolio. Now, what happens if tomorrow US dollar weakens and rupee strengthens? So 75 rupees per dollar becomes 70. What happens is all these companies who are all getting their revenues from US dollars will suddenly miss 10%, 8% of their revenue, and they will all collapse. And that's why each of these have one or the other risk. Now, for example, Maruti, material stocks are going up, prices are going up. That means the metal they need to build the car, the input prices are going up. Now, if they can't hike the prices of the cars to give it to end customers, then their business is down. So everyone in this list, each of these sectors have different sort of risks involved. And that's why you need to have a balanced exposure to each of them. So you need to have a 40% defensives and 40% cyclicals in your portfolio, and then the rest 20% you can do whatever you want across. Next thing I want to break down is by style. I'll talk about value companies. The biggest example is ITC. Now, ITC has a low PE ratio compared to everyone else in that sector, cash generating. And as I said, just because it is something is cheap doesn't mean it will go back to its fair value. And people have been waiting for ITC to go up. I've also been waiting for ITC to go up. It just doesn't move. It is one of my biggest investments, but that's how it is. That's how value investing is. That's about ITC. Next thing I want to talk about is growth. Okay. Now this is again different than value. Growth, give a very vague example would be Zomato. Okay. The company has PE ratio is negative. They have never made money. Will they make money? We don't know, but everyone expects them to make money. And that's why they're expected to grow. That means their earnings are expected to grow like crazy. So their history won't be great, but people will believe their future will be great. They will grow like crazy. For example, Apple, Amazon have all been growth companies in the past. They won't be growth companies now because they have sort of matured, but they were before. And that's how you would try to do it. And of course, growth is always more riskier than value. And then you have dividend companies. Now, what dividend is basically, it's like getting interest on your stock market. Basically, when you buy in a company, they will actually give you back some profits. And you can also look at dividend yield companies. For example, Coal India last year gave a dividend yield of 11%. So if you had invested 1 lakh rupees, you will receive 11,000 just as dividend. Instead of putting FD for 5,500. 5.5%. But however, of course, the stock prices can correct also. But so these are different ways to look at it. And the way you look at it is actually a combination of them. So you will have small cap value, IT companies and all that. So you need to be aware of this and see how different market cycles you have your own view. And then basically try to construct a portfolio. Finally, though this is not companies, finally, I want to talk about ETFs. Now, for people who don't know about it, ETFs are like mutual funds. However, they're listed on the stock exchange, and it's almost like it's a stock. It's like a share only. So ETFs tend to track indexes. For example, the biggest ETF is actually Nifty ETF. Instead of you can just put 150 rupees or 200 rupees in one ETF unit, and it will almost be like it will track the entire index. So why people invest in ETFs is it has the lowest expense ratio, just 0.1%. So these ETFs are mostly large cap, and someone who's just starting out in their investment journey, who wants to take very low risk and just be invested in the market, they tend to start off with ETFs. So you put money in ETFs, and you actually sometimes, a lot of people move money from mutual funds to ETFs because the expense ratio is lower. So mutual funds will charge 1.5%, whereas ETFs will charge just 0.1%. So your net return will be higher. And this is only in the large cap. Of course, mutual funds will actually be active investing, so they will make better calls also. And that's why you can actually start off by investing in ETFs as well. However, no investment, no sector, no small cap, large cap is devoid of risk. Okay, if you don't want risk, the only thing that has no risk is fixed deposit, and that too not everywhere. If you put in Guru Raghavendra Bank or DHFL, even that might go. But everywhere is risk. Anything that is market risk, it starts at ETFs, and as large caps, and as you try to find more and more returns, you will have to take up more and more risk. If someone tells you, hey, I will not take any risk and I'll give you returns just like that, that's probably means there is something fishy going on. Okay. I will now move on to taxation. As I said, dividend is something, it's like interest on deposit. So it's like in same thing on shares. So it is taxed at your slab rates based on the new tax act from last year. And income from trading investments, we can actually divide it into 4 sections. There's something called speculative, which is like intraday trading. There's short term, basically the time period between buying and selling is less than 1 year. That is short term. And then there is long term, which is more than 1 year. So if you buy today and hold there for more than 1 year and then sell it, then it's long term. As you see, the government wants you to invest in long term. They don't want you to be traders. And that's why what they do is they charge higher taxes on shorter term period. So speculative is at slab rate. So someone who's earning more than 10-15 lakhs will be paying 30% tax on this. And then short term is 15%, and long term is up to 1 lakh. It's actually free. So if up to 1 lakh rupees of gain, you don't even have to pay any taxes. Only above that, there's a 10% tax. So now let me move on into some trading do's and don'ts. So I want to start off by speaking about how you place orders. Okay. I want you to see the image on the screen, which is a replica of something you call an order book. Okay. Or it's also called market depth. So what happens is on the left side, you have buyers. On the right side, you have sellers. So these guys, it's almost like a market. It is exactly like a market where people they want to buy this many shares at this many price. And once they meet, the trade happens. Now, why am I showing this is you need to be very careful at what price you buy and what price you sell. Now, there are 2 types of orders, which is called limit order and market order. Now, what market order means is you will just say, I want 100 shares. You will not say the price. Whatever price is available in the market, it will just go and buy it at that price. So right now, if you put a market order to buy 100 shares of Infosys, it will buy these 20 shares and then 1 share, 4 share, and the remaining 75 shares will come at 156. So this is how you buy at market order. However, if you have a limit order, basically where you tell what price you want, you can actually say, I'll put it at 1055.05, and US will be the first to execute, and you will get a better price. So at time, it is always necessary that as much as possible, you try to place limit orders so that you're in control of the price at which the trade is executed. Next thing I want to talk about is shorting securities. Now, this is very rarely done, but a lot of risk-taking investors can actually, if they believe a security is going to go down, they can short a security. The biggest problem with shorting is there can be circuits on securities, which says upper circuit or lower circuit. Now, what does that mean? If 5% upper circuit, that means that stock cannot go above 5% or cannot go down below 5%. That's it for the day. So if you have, for example, bought a security, okay, and if it is at lower circuit, that means you cannot exit that day at all. There are already sellers there. So you need to be careful around all these circuit securities because they are kept as a risk measure. So be careful about them. And next, I want to talk about things that affect your stock prices. For example, you have made an investment or you have even made a trade. The biggest thing that affects a stock is actually either news, announcements, or results. Now, results come every quarter. So, company suddenly this quarter their NPA has gone up. That means they have given people loan which they shouldn't have given. So then the stock will collapse. And if suddenly they made good profits and their margins are improving, or then they would actually go up. Same thing about news. Yesterday, the news came out that China wants to release resources and reduce metal prices across the board. All metal stocks, Vedanta, NMDC, Tata Steel, everyone was down anywhere to from 7 to 10%. Because if the price is lower, they will have to sell lower and they will all have to make lesser profits going ahead as a business. And you need to be, you don't, as a long-term investor, you don't need to react to each of this, because if you believe in the business, you can continue to remain invested. However, if something is crazy wrong for something like corporate governance, they're trying to merge with a subsidiary. This is what Satyam tried to do just before everything hell broke loose. So all those things are seen as a bad omen, and it's so you need to be careful and only evaluate these results and announcements in your original view, saying, okay, I would have still invested in this despite, okay, the company made 5% less profits. It's okay. I don't have a problem holding on. But if it is down 60% and something is seriously wrong, then you may need to think, okay, I made a bad call, let me exit. So you need to view those news and then accordingly take a call. Finally, I want to talk about stop loss and good till trade orders. Whenever you're doing trading strategies, and this is not necessary for investing, you tend to have a stop loss, 5% to 10%, and it basically tells you, okay, I don't believe in this, let me get out. It is a good practice if you're not following the market continuously to have stop losses. And good till trade is basically this is a feature that's not available with all brokers, but it's available with multiple brokers. Basically, you can put an order to sell any other day also. For example, you have bought it at 100, you want to sell it at 1200. That order, you can put a GTT at 1200 to sell, and it will be open till it is executed. So it is good till traded. And that's another order you can make use of once you have started investing. And finally, actually, I should have spoken this about in the earlier. It's about position sizing. Now you have 1 lakh rupees investment. I wouldn't recommend anyone to actually take more than 15,000-20,000 rupees in one share. And this is again going back to diversification. You need to ensure that all your eggs are not in one basket. So try to split money into different securities across different sectors and take care of position sizing and risk. And you would be able to make considerable alpha over time. And that's basically diversification. That's it from my end. Shruti?
Yes,
Excellent,
Shailesh, you were amazing. I've made notes as well, so I was very involved in the session. So thanks, Shailesh. So yeah, we have quite a few questions. And I'm going to start actually with Atul's question. Atul asks us, does a REIT, and it's more a comment as well, I think, with the question, does a retail investor always remain subservient to the big bulls and bears who influence the markets?
Over short-term periods, yes. It has always been believed that order flow moves the market. You have ETFs, you have fund flows. For example, LIC is the largest investor in our market, right? And if they decide to buy a security, that stock will go up because they buy thousands of crores, right? And at short term, yes, and in small cap, mid caps, even more. But over larger periods of time, It is the business, it is the earnings that drives the stock market. And it doesn't matter if there is a bears who want to hammer Reliance or HDFC. If they are making considerable profit over time, it will always go up.
I have a different take on that. I mean, answer is the same, but let me give my experience, Shruti, here to others. I have seen large institutions behave exactly the same as how the retail investors behave. So a lot of times they also get emotional and they chase returns, and they buy high and sell low. And when I'm talking about it, I'm talking about large institutions investing in excess of $1 trillion. Okay, so it's not necessarily true that the large institutions have an advantage over the small folks, but it is about people and their understanding of it. If you're going to get into the market without spending time, without understanding it, you're definitely going to be a victim. Rest of it, I think the opportunity is the same. And more importantly, because information and processing is now democratic, because of which I think the opportunities for retail investors like me and Atul is the same as the opportunities for the large investors.
Thanks, Ravi. Ravi, also your audio, I think just check your volume once, Ravi.
Yeah, I'll switch to a mic.
Yeah, so I have more questions. Later, before I come to yours, and I saw that's a very interesting question. I just want to, Yash, you had requested to record, but of course we are recording this, and you will get this recording. Just want to let everyone know. I've got 2-3 requests saying, please send me the recording, and we will definitely do that. Shailesh, you spoke a little about it, but Manik's question is a little more specific. He asks, request you to tell us about loss adjustment of previous years as well.
Okay. Long-term capital gains, losses cannot be set forward. So for example, how much loss have you made in what is important? Now, earlier, long-term capital loss gains were not taxed at all. So there was no point to actually set it off against something. Now you can, short-term capital gains, so always you can. So if you had short-term capital losses, you can set it off against short-term capital gains. For example, you made a trade last year, you lost 15,000. This year, if you make 25,000, that 15,000 of short-term capital losses, you can set off against short-term capital gains. The remaining 10,000, on that you will be charged 15%. So there is set off available for short-term.
Okay. Okay. Ranga asks, why ETF instead of index funds, which has a better expense ratio? And when you're answering this, Shailesh, if you can just throw a little light on, P ratio and, some of that, it'll help the audience here today.
Yes. Earlier, so there are 3, earlier most investors start off with investing in mutual funds, right? In mutual funds, again, you have something called large cap mutual funds or small cap, mid cap, who charge anywhere from 1 to 2.3% charges. Okay. Then mutual funds themselves started coming up with index funds, which charge about 0.3, 0.5, 0.6. Then came up ETFs, which are now, again, most of them are index funds. So ETFs, a lot of the ETFs are actually index funds themselves. The biggest ETF is actually in India, the Nifty index fund itself. So there is no difference between them. And some of the index funds have 0.1%. So clearly ETFs have a lower expense ratio than any mutual funds. And also the plus point of investing in ETFs is you can exit anything right now. For example, the market opened at 10 o'clock, okay? And you think about some news and you think, okay, markets are going to collapse over the next 2-3 days or weeks or months, and maybe I want to move out, right? You can exit at current prevailing prices right now. However, with mutual funds, they will only give you end of the day NAV. That means even if you want to decide at 11 o'clock that you want to exit, they'll only give you the NAV that is applicable at the end of the day. So only after that day's profit or gains of the market is calculated, they will calculate your NAV, and then you will be able to transact. So in that way, ETF gives you more flexibility to gain access to the markets.
Okay. Speaking of news, and you just spoke of that, Lydia asks, today's news reads that foreign investors begin dumping stocks. How will this affect the Indian market?
Yeah.
Ravi and Shailesh, I'd like both of you to comment on that. Yeah.
Yeah. So from about May end to about July end, August second week also, FIs have been continuously selling. Their net numbers have always been low, and it's the domestic and the retail investors that have been buying. Earlier, retail was a very small section, and I know someone was asking about 1.8 million new retail investors making a difference in the market. Yes, they have. So nowadays, if you see the volume split between FIIs, domestic institutions, and retail has a larger chunk than they did in the last 2 years. And FIS are obviously, they have their own view, but they tend to be wrong. So the index funds over the last 2-3 weeks have gone up a lot, and they were actually selling weeks and months into it, and they have actually missed out. So just because FIs are bought or sold doesn't mean they are smarter. Sometimes it's the domestic institutions that have made money. One more example, during the COVID crash, every FII, everyone was selling, right? LIC bought everything in the market, and they now turned out to be one of the smartest investors out there because they made so much money. So it's a overviewed insight. It doesn't really matter on a day-to-day basis. But yes, if foreign ETF flow a lot into the market, and they will go mainly into large cap, because the indices will tend to track the large cap securities, and the large caps will tend to outperform, and there will be some balance towards it. So ETF flows definitely matter, but not so much into the wider market as a view.
Okay. Ravi and Atul, this is your question. Will the new 1.8 billion new retail investors make a difference in the market? And another question that I got, which I'm adding to it, how does InvestorAi, what role can that play in this whole new set of investors coming into the market? Ravi, if you could take both.
Okay. First thing is, am I audible now? Still bad?
Yeah, I can hear you. I'm just going to wait for some people to message in on the chat. Everyone, can you hear Ravi? Ravi, can you say a sentence?
Yeah. Hi. Can you guys hear me? Yeah.
Yeah.
Thank you.
Yeah. Okay. Go ahead.
In fact, I'll also club another question or another observation from Yash, who says that, oh, it is insiders who actually make money, not others. Okay. So I'll club all of the two. In fact, all the three. First thing is, as Shailesh said, typically, traditionally, retail investors were reacting. They were not actually analyzing, they were reacting. So their brokers will say, hey, buy whatever, India Bulls, and everyone will buy India Bulls. And so they were all looking for tips. And I still remember the days when people will come and ask me saying, hey, you're working so-and-so places, can I buy the stocks? And honestly, there's no way that I would know. Okay, so that is one. Today, information from multiple factors are capable of being processed by tools like InvestorAi. So you are able to get all information and not react to a single data point. Like Shailesh was saying that, oh, when FII flows change, things will change one way or the other. And I'm saying that's one of the million factors. And then Shailesh was talking about, hey, China producing more steel, China producing less steel, China consuming more steel. There are so many factors, and it is very difficult for a retail investor to factor all of that. And so if there is enough information available in a processed manner, I think it is very important for retail investors to consume that and not be taken away by these so-called insiders. Okay, the so-called insiders are half the time either ill-informed or they manipulate, one of the two. And so I am saying the large number of retail investors coming puts a lot more responsibility on institutions like SEBI to enforce insider trading prohibitions. Yeah, there are always crooks in every place, but the crooks are being chased very, very well. Even if somebody trades as small as 100 securities during a prohibited period with private information, there is enough AI that is being run by the SEBI and others to catch them. So opportunities from insider trading is, first thing is it's fraud, so we shouldn't be thinking about it. Two is that's not a great opportunity, and that's going to go down, and retail investors are going to do well with providers like InvestorAi, who can assimilate data and give it in a processable form. And of course, there will be other players who will come there. But it's important for retail investors to be empowered, and that's why this group is a great group to be with. Shruti?
Yeah, great. Yeah, so I want to, actually the next question is an interesting one on Zomato, and we have Sarthak here. Sarthak is our product head. Sarthak, I want to give you this question. Why is the focus today on valuations and not on the balance sheets? Someone like Zomato is ridiculous. I don't think they will ever make money. This is something Atul has asked us.
Yeah, I mean, look, the thing is, it's always been there. If you really look at, there's a fantastic YouTube video where Jeff Bezos speaks about the electricity conundrum. It's a great watch. Do watch it. There's one of those pieces where he speaks in 1999. They made, 100 million of revenue and 20 million of loss. So, you're selling $100 at $80 less. So everybody is buying. And that was the case, right? And nobody thought they will ever make money. But if you really look at this 20 years from now, they're the biggest company in the world, right? See, it is always, one thing to look at valuations. It is always also important to look at the nature of the business, right? If somebody like a Zomato and Swiggy are that kind of a scale, it's very difficult for a small scale, app to come and replace them. So, they have pricing power going back. Later on, if they decide to increase powers, they can do that. And again, they have restaurants in their, pockets right now. Whatever they ask, okay, this is the share you have to give them. So, look, the nature of the business also dictates the valuation of the company. And why do people look at valuations today? Well, there are some people who cannot, it's old school, right? You still look at valuations, you still look at metrics before you make those decisions. But most importantly, if you look at the last 6 months, economic cycles have become very short. We have, people who've been with InvestorAi, Shrirams and the rest of the world, they know, stocks do 20-30% and they correct back, instantly give up those gains. This never used to happen before. I mean, in that magnitude where, the cycles used to be longer. That's why I think it is very important to look at InvestorAi as a tooling, right? Because we're not trend followers, but a lot of our intelligence, majority, our DNA is pattern detection. Right? So if anything of that sort's happening, if there is massive buying, it automatically reflects in those signals. So, sorry for the long answer, but in terms of Zomato, look at the signal. That's all I can say.
Speaking of what you said, nature of business is one other question that's come to me directly. And Shailesh, this is for you. Because in this whole thing of basics, a lot of people say, but how do I read fundamentals, right? Is that part of the basics? Is that very important at a very high level? I know you may need 3 sessions to do, to explain fundamentals, but can you at a very high level tell us why that is important?
Yeah. Sarthak, you want to take that? Yeah,
no, with a CA, CFA, FRM, I am not going to take that.
Okay. The thing about fundamentals is, there is this statement that comes out: the proof of the pudding is when you eat it. Now, so you can always say, "Hey, my future is like this. I'm Zomato. I'll make 10,000 crores profit." But boss, till yesterday, what did you do? That question will always come out, and that's why you would always look at fundamental securities, and you like to put a portfolio in them which will grow slow, but they will not collapse either. So it's all about moderation. It's all about diversification. You will like to have some growth, but you'll also have to have value in it, value companies. So for analyzing this slow mover toys companies that you want to invest in, you'll actually look at fundamentals a lot more and try to evaluate them. And for growth, anyhow, it's a different metric. What is they will try to sell you dreams, everyone's dreams. That's another thing. But you definitely have to look at fundamentals. The first step of fundamentals, I would say, is price earnings ratio, which is basically how many times you're paying for that company's earnings that year. So, and that obviously lower is better. And again, it's not comparable across sectors, like I said, but at least you could say, for example, 1.5 years ago, I invested in Infosys and not in TCS because they were both large cap tech. However, Infosys was trading with a much lower P ratio than TCS. So Infosys sort of caught up that valuation. So if you see the last 6-7 months, Infosys has been moving up a lot more than TCS, though they are one of the two biggest companies in the country. So some small metrics like this you can do, but there is a lot more metrics which I think I would need a lot of sessions. But when someone says valuation, it's mainly starts with P ratio, but there is margins, there is other valuations because you can't sometimes evaluate on EPS. I'll do it on a future.
So Shailesh, we are going to do one, I think, because looks like, we will have to get into also educating people on that.
Yeah.
Ravi, while you've answered, yes, I see. But let's take this as the last question. I know there are some more, but please come back next week. We will pick that up. The last question is, I'm combining what Lydia asked about how does InvestorAi take into consideration intangibles? And at the same time, Ravi, what you just answered to Yesh, if we can just explain how is InvestorAi different from all the other apps out there. So, yeah.
I'll defer it to Sarthak after I give a starting to the answer. The first thing is there is so much of information that is available today, and our ability to process all of them is humanly difficult, and so we need a machine to support us and help us. Otherwise, we'll always be at the mercy of large institutions who have that ability to process. That is why InvestorAi becomes relevant, because it doesn't react to a single trigger, because there are multiple triggers. And so when we talk about algos, and whenever I discuss it with Sarthak and Shailesh, I mean, each trigger gets different weights, and all of that happens automatically by the machine.
Ravi, so just be loud, please. Just be loud.
Yeah, machine is dispassionate is one. And the second thing is the machine is also capable of processing multiple data points over periods. And it also corrects itself by evaluating it. So it's clearly different. I'm deferring it to Sarthak to actually answer how are the various factors factored in, including, of course, intangibles.
Yes, thank you, Ravi. I mean, that's a very good answer. I'll try to add to that more than what you just added. See, the thing is, the entire idea of an algorithm is based on a method, right? And the method for us is based on computer vision. What do I mean by that? It is basically teaching the system different feature sets, etc., from the 10 years history that we cover, and showing that when the price earnings was like this, price to book was like this, exchange digital exhaust is essentially how many people are trading and how is the volume and all of that. That tells the system a lot more, right? I mean, think of it this way. Whenever we look at valuation, we look at 3-4 numbers and we try to make a judgment. A system does that with over 400, 500 features in typical models, right? And the dimensionality of actually associating features together and then trying to make not judgments, but predictions, which are actually a part of the history, that the system has learned from, that makes it very, very different. And I see that the question said, like, how is it different from what we're getting from a broker, right? Look, the thing is, that's old school equity research. That's where, me, Shailesh and all of that, we've done all of that, right? Where, I've done it for UBS, for a long time. The problem is that those research were very good when, markets used to trend for a longer period. You put a buy call, then you do a buy call after the results. It was okay because stocks wouldn't, have a drawdown of 20% and go up 30% after that. But having said that, in the last few months, and just look at the market dynamics are changing. 1.8 new million retail investors, foreigners pumping money, dumping money. It has changed. It is not changing, it's changed. And in such a case, old school research becomes, inefficient or decays very quickly. Let's say somebody has given you a price target of 20% above. Let's say it's just done that in 5 days. The research guy is not going to write a new report on this. The same report will be 10 days old, right? But when you are trying to take a position, what do? You look at the 20 page report 20 days back, or you look at what's happening right now, right? So see, those things are very, very important when you're really looking at a signal based approach and research based approach. I mean, look, it works. It's not that it doesn't. It's just that it has lost efficacy in the last few days.
Thanks, Sarthak.
Thanks, Sarthak.
Yeah, this was it's a good one, and why we're different. We have run out of time. I just want to let everyone know, download InvestorAi. We have a 15-day free trial. Post that, the only discount that's available is in the first 2-3 days as soon as you finish your free trial. So make the most of it. The free trial also teaches you a lot about, of course, the stock market, some of the things you learned today, and helps you like what you just asked. You'll know what the difference is between all that information out there and what we are able to sort of give you as clear insights in terms of what you might want to take action on. So InvestorAi on your Play Store or App Store, download the app or come to our website, investorai.co.uk. And good news is very soon, in about a week or two, we're going to have the user forum up. This is a community which will be available from your app and also on our website itself. You will get to hear more about this next week in our webinar, because that is a place where you're going to learn and you're going to interact with each other and ask all those questions that you possibly have, and have discussions in a way where you can also find those threads and continue to learn more. So we hope to see you there, but we will of course give you more information next week. But thank you so much, and thank you Shailesh, Ravi, and Sarthak. This was just fabulous, the session, and I think a lot of people said, of course, Atul, we will try and get this out on our LinkedIn pages and other social handles. So thank you very much, and see you next week, same time, same place. See you then. Stay safe. Bye, everyone.
Thank you.